Hello, everyone. My name is Octavio from Yama Financial. Today, we're going to go over a pretty standard chart of account for a winery. Just keep in mind that each winery is different, so depending on the winery, they'll need different chart of accounts. But this one is a pretty standard chart of account. So let's start. We're looking at balance sheet first. So we got checkings and savings. So pretty much all your cash accounts, your AR, prepaid expenses. Popular one is property tax, because when you receive a property tax bill, it's for the full year. So you don't want to expense all of that in 1 month, right? Because it's for the full year. So you would put it into the balance sheet and then amortize it on a monthly basis throughout the year. Then we have inventory. Inventory could get a little bit complex, but we'll talk about it more once we look at the P&L accounts. There's a flow to it. So we'll talk about that once we get to the P&L. Food inventory, merchandise, other inventory. And then over here, we're looking at fixed assets. So essentially, these are designed for expenses, like tangible expenses. That is a material amount. Depending on the winery, that definition of material is different. But a pretty standard one is expenses of $5,000 or more. So let's say you purchase furniture for $10,000. You don't want to expense that all in 1 month in the P&L. You'd want to stick it into fixed assets and then depreciate it based on the life of that furniture. For furniture, it'd probably be like 10, 20 years. So that way you get a more accurate representation of your financials. Construction in progress. So this is for projects that are ongoing. So let's say you're building out a winery. What was it, like a 1 year, 2 year project? All of those bills go right to construction in progress, and they don't get depreciated. It doesn't get depreciated because you're not using that winery yet. So it stays in construction in progress. And then once that project is completed, then you would move it over to these fixed assets account. And then that's when you would start depreciating it on a monthly basis. See current liabilities, your AP, unpaid bills, sales tax payable, credit card, payroll liability, deferred revenue, line of credit. Deferred revenue is pretty much like unearned revenue. So a common one in the wine industry, like wine futures. So let's say you sell wine for next year, right? So let's say, what are we, 2025? So let's say you're selling futures for 2026 vintage, and you receive that revenue, you receive that cash, but that you haven't shipped that wine yet. So it would stay in deferred revenue. And then once that wine gets shipped to the customer, that's when you would recognize the revenue and you would move out deferred revenue and move it over to wine sales in the P&L. Long-term liabilities, like your notes, debt, long-term debt. Equity would be contributions, distributions from the owner. Chain earnings, that's pretty much roll forwards of previous year's net income. And then we're looking at P&L accounts. So we got income, wine sales generally broken out by two main categories, right? DTC, wholesale. Depending on the winery, they might have a different account for wine clubs, if that's a big component of your income. Or if it's a smaller winery, they just all lump it up into DTC. So just depending on the winery, this will change. Food sales, event income, shipping income, smaller activity accounts, discounts, cost of goods sold. So when you look at vineyard costs, so this would be all your vineyard expenses, all these different accounts for that vineyard expense, pretty self-explanatory. Bulk wine as well, bottling. So let's go over one so that way you can get a general idea of the flow. I guess bulk wine is a good one. Let's say you purchase like $5,000 worth of bulk wine. You need to expense that once you sell that wine, right? Because there's like a matching principle. So let's say you get that bill in October 2025, but you're not going to sell that wine until 2-3 years down the line. So that's why you need to capitalize it. So you're going to move that out using the transfer cost to bulk. You're going to move that into inventory. Let's see, where is it? This guy right here, bulk wine transfer in, and it stays there. And then once it gets bottled, then you would move it to transfer to case of goods. And then it would stay right here, the case of goods inventory. And then let's say 2-3 years down the line, and then you have to do some costing outside of like QuickBooks. But once the inventory gets sold, then it goes over here. It exits out the inventory. It goes case of goods sold, and then it hits the P&L in this account right here. So that's why there's a flow to it. If you don't know what you're doing, it could get complicated. But if you're very comfortable with accounting, costing, it's pretty straightforward. But yeah, it could get complex. So yeah, that's the same for vineyard costs. For bottling costs, that just gets transferred over to case of goods. It doesn't go to bulk wine. It goes strictly to case of goods. And then going over here, we're looking at expenses. So pretty much your operation expenses broken up by three different departments: administrative expenses, marketing expenses, and sales expenses. And just depending on your winery and your needs, you could have different departments. That's pretty standard. When you look at admin, the big ones are going to be your employee expense, insurance, rent, professional fees, depreciation. And then marketing, the big ones would be A&P, meals and entertainment, travel expense. And then sales expense, merchant fees, outside labor, storage and delivery. But yeah, pretty self-explanatory. And then we're looking at other income. Let's see, like insurance proceeds, interest income, sale of assets. So like fixed assets, say you sold a vehicle, go right here, sale of assets. Other expenses, interest, credit card interest, finance charges. So yeah. And then when you look at it, your current assets, they're the 1,000s, liabilities, 2,000s, equity, 3,000s, income, 4,000s, cost of goods sold, 5,000s, and your expenses, the 6,000s, other income, 7,000s, and other expenses in the 8,000s. So there's a flow to it. But yeah, that's pretty much it. If you have any questions, feel free to reach out.